Hey everyone, welcome back to Corporate Decoder. Today we're diving into a financial report that's got a real before and after story brewing, like watching a restaurant get bought out right before a big remodel. We're checking out HarborOne, Bancorp's latest quarterly filing, but stick around because this might be their last one as an independent company. HarborOne, a bank known for its community focus, is planning to merge with Eastern Bankshares. You can think of it like a financial marriage, and this filing gives us a peek at HarborOne right before they walk down the aisle. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us for more details. First, let's take a look at the numbers. We'll start with the most recent balance sheet, a snapshot of what the company owns and owes. Loans, after setting aside money for potential losses, what they call allowance for credit losses, came in at 4.77 billion of last year, when it was 4.80 billion last year, when it was 4.80 billion last year, when it was 4.80 billion wait, then before the company held 43 billion, $14 million shares in common stock. These are the instruments used by investors and traders to place bets on the direction of the company. Total stockholders' equity, which can be thought of as the actual worth after debts are paid, is $575.96 million. A company with more worth is considered more stable for future growth. Now, let's see how they performed over the last 3 months. Interest and fees on loans clocked in at $59.87 million, a tiny dip from $59.94 million the year before. It's almost like they're running in place here. This is all the amount they earned through interest and fees on their loan. Interest expense, what they have to pay to borrow money, came to $32.97 million, which is less than what they recorded the previous year. $36.32 million is great for the company as they pay less on their debt. The amount they provisioned for losses was $123 million, compared to benefits from the provision for credit losses of $168,000. When a company raises provisions for losses, it indicates that they see a higher risk of defaults, which is not a good sign. Diluted earnings per share, or EPS, a key metric for profitability, was $0.14, a drop from $0 from 17s in the previous year. This means less profit per share is going into investors' wallets. Another important indicator of success is comprehensive income, which is not all that glitters, as it came in at $9.73 million for the period 1 year ago. Seems like the company is doing better than it would appear at first glance. Now let's check out the gains and the earnings section. A company can only retain the value it generates. Total non-interest income was $929 million compared to $10.74 million from a year prior. That's a bit of a dip. A few points. Income on retirement plan annuities was $119,000 compared to a higher AR $14,500, and bank-owned life insurance income was very similar at $743,000 and $746,000. Time to check the liabilities. On compensation and benefits, the company expensed $18.78 million. This is higher than the $17.63 million from the previous year. Foreclosed and repossessed assets did not make any impact at all, showing a very steady number of loans at risk. The company paid $1.65 million in income taxes, less than 244 funds the previous year. It might sound good, but this means their pre-tax profits were lower. Important to know that Joseph F. Casey, President and Chief Executive Officer, and Stephen W. Finocchio, Executive Vice President and Chief Financial Officer, signed the document, meaning they are liable for it. Management indicates in their report that key accounting policies that they followed, also known as significant accounting policies. HarborOne Bancorp Inc. has a number of subsidiaries such as HarborOne Mortgage LLC and Legion Parkway Company LLC, among others. It's worth noting that all significant intercompany balances and transactions have been eliminated in consolidation. These intra-group operations can affect revenue reports if they are not handled carefully. But here is the biggest news. On April 24, 2025, Eastern Bankshares agreed to acquire HarborOne. This is a major change, and it means the bank as we know it might not exist for much longer. Like a TV show getting cancelled after a few good seasons, loans can also be sold off to investors to raise capital, which might be necessary for expansion. HarborOne sold $125.9 million last year compared to $92.79 million last year. The net increase in the gains compared to the expenses after the benefit and provision for loan losses was $30 million. million this year compared to $75 million 1 year prior. Another income source to be aware of that many companies use is bank-owned life insurance, which contributed $743,000 to their profits. You can think of it as companies using mortality bets to generate safe revenue. A key item that cuts down a company's earnings and something that Warren Buffett is a stickler for is any non-interest expense on items such as compensation, occupancy, which has to do with the buildings they use, data processing, loan expenses, marketing, postage, professional fees, among other expenses. Then there's other comprehensive income. Think of it as unrealized gains and losses, a hidden bucket of value, which for this quarter was $423 million. These values will show up when they are actually sold action for in the future. Earnings per share for common stock basic came in at 0.117 this year, down from $0.17 last year, with a share count of about 40 million. Diluted also shows the same numbers. Let's move to the key accounting principles that HarborOne's managers follow for their reports. The merger section is a must-read. Eastern will acquire the company and bank in a merger that involves shares of company common stock and stock consideration with Eastern. The company anticipates this being completed around the end of 2025. Then there are the fair values of investment securities. They use a 3-level system for this. Level 1 uses quoted market prices, Level 2 uses other observable inputs, and Level 3 relies on the company's own assumptions. This is not great if Level 3 assumptions are high. Some key details of this report are non-obvious and will come down the road. And the company provides some detail on the loans that are still being processed, so not yet revenue, as well as foreclosed properties they will have to account for on the books. Accounting standards have remained substantially unchanged since last year, indicating a consistent approach to financial reporting. The securities available for sale were valued at $265.64 million. Loans held for sale accounted for $19.13 million. Regulatory capital is another important factor. There are certain metrics that companies should hit to be within compliance. The capital conservation buffer, for example, which is about 11.9% of assets. Now let's zoom out a bit and connect the dots. HarborOne is making a bit less money per share, but it is still profitable. The merger with Eastern Bank shares is a really big deal. While we don't get a pro forma or combined projections, it's safe to say the main driver for the merger is to achieve higher income in the future with combined resources. With that said, there are a few yellow flags to watch. First, there are risks related to the merger. There is a chance that merger will not happen, which could hurt HarborOne in the long term, since they would have been betting on it. Additionally, there are some concerns with non-performing assets in a tricky economic environment. If these loans start to default, the earnings could suffer. This is all for this deep dive. Make sure to follow the corporate decoder on the platform where you are watching this. What are your takes on the company? Drop your thoughts in the comments. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.